Well, as Mark has mentioned, the banks had a week they'd rather forget, as once again fear trumped greed as the dominant emotion among investors. Some soothing words from the Reserve Bank were largely ignored, as the market seemed to believe the ongoing crisis in Europe, credit rating downgrades and a spluttering local housing market were telling a far more compelling story. Neil Woolrich reports.
As protesters descended on the Greek parliament again this week, the nation itself took a few more steps towards default. Greece is warning it needs more money from the International Monetary Fund and European Union, or it won't be able to pay pensions and public service salaries. However, the IMF is threatening to withhold the next round of bailout funding if Greece fails to get its house in order.
It's going to be a tough environment for Greece anyway. There's no way around that. It's already a tough environment for Greece.
But as the crisis deepens, Greece's political leaders remain divided on how much its budget will be tightened.
So our view is, on the one hand, it's a big issue, it's going to end badly. On the other hand, we're not so sure that it's imminent, and our hunch is Greece can probably struggle through into 2012 before we really hit the crunch.
The latest Greek drama, coupled with some softer manufacturing data from China on Monday, saw investors retreat to their bunkers this week. In Australia, the banks were hardest hit as short sellers targeted the Big Four, wiping between 2 and 4% off their share prices.
I think what investors are saying is there's a chance that we see a hard landing either in Australia and or in China, and one of the sectors that would suffer under either scenario would be Aussie banks.
Offshore hedge funds have taken the view that the Australian residential property market is overvalued, and given that the Australian major banks are overweight lending to the residential property sector, they've been waiting for a catalyst to put on their short positions.
But Evans and Partners banking analyst George Gabriel thinks the short sellers have got it wrong about the Australian banks.
Given they're operating in a challenging revenue outlook environment, the most likely outcome is that they'll trend sideways. So investors in that context should be finding bank stocks with their own stock-specific or bottom-up value drivers.
While investors were spooked again, the Reserve Bank is not hitting the panic button.
There's all sorts of issues around. Whether they come to anything, who knows? But the cycle at the moment is on an upswing.
Despite those soothing words, once again speculation is growing. There's a housing bubble in Australia that's set to burst, and that's brought the banking bears out of hibernation.
People have been forecasting a decline in Australian house prices for a long time. But I think that sort of forecast doesn't really take into account the factors that are at work here in Australia, particularly the population growth and the fact that incomes are still rising.
My view is that house prices are about 40% over fair value. Yes, I think we've got a bubble. On the other hand, will it burst? Look, the thing that will pop an Aussie housing bubble violently is broad-based job losses. Do I think we'll see broad-based job losses? Not anytime soon.
Lending support to the housing bears, Australian home prices have dipped slightly since March, housing finance is trending lower, and auction clearance rates in many capital cities have fallen to levels last seen during the global financial crisis.
I think that house prices are high in Australia, but I think there are good reasons why house prices are high in Australia. We have limited supply, we're not building enough houses, and we also have a relatively high quality housing stock.
Even if the Australian housing market does avoid a crash, some argue the major banks remain vulnerable to shocks in wholesale funding markets. That point was reinforced last week when the credit rating agency Moody's downgraded each of the Big Four. Some also fear that any further trouble in Europe could make wholesale funding more expensive and harder to get.
I've always felt that the risks that people point to in offshore borrowings are often overstated because people don't really understand how the Australian banks are managing those risks. The crucial point is that those offshore borrowings are all hedged back to Australian dollars and they're used to fund Australian dollar investments.
We've seen them reducing their reliance on wholesale funding internationally, so it's now the case that only 20 cents in the dollar actually comes from international wholesale funding markets for the banks as a whole. And we've also seen them increasing the tenor of their borrowing, so they're actually borrowing at longer lengths.
The other dark cloud looming on Australia's horizon is China. This week saw a 1.5% fall in the Purchasing Managers Index, a sign that activity in the manufacturing sector continues to slow.
The only way that they can get inflation out of their economy is to slow it down. We're seeing that they seem to be orchestrating a soft landing, and that's better than them orchestrating a hard one.
We could have quite a significant slowdown in global growth next year. That would mean weaker commodity prices, weaker Aussie dollar, and if the RBA has already tightened policy in Australia, there's the real risk, in my view, of a domestic recession next year.
But despite the ructions overseas and looming global slowdown, market pricing says the next interest rate rise in Australia is simply a matter of when, not if.